G'day, Ziggy here, and welcome to episode 5 of my podcast, Plan to Prosper. In today's episode, we're going to be talking all things self-managed superannuation funds, or as a lot of people know it, SMSF. It's very popular. It's gaining lots more popularity. A lot more people are setting them up because they want to do property. So we're going to have a chat about that, bust some myths. But before we get into it, first joke. What's the joke? If you want to get in touch with your long-lost relatives, how do you do that? You'll win the lottery. Sorry, hopefully there's a ha-ha-ha, a laugh in there. I did like that one. Anyway, so let's get into it. Okay, so self-managed super funds. Well, as the wording suggests, it's a superannuation fund that is self-managed. What does that mean? You manage it yourself. What does that mean? Well, self-managed. That's pretty straightforward, isn't it? No, it's not. Okay. All right, self-managed super fund. So it used to be a lot more known as a DIY fund, so a do-it-yourself fund. So a self-managed superannuation fund is when you take your superannuation money, you set up a structure. So we'll talk about what that structure is in a moment, and you do a whole range of things. You become responsible for the investing, responsible for all the compliance and administration, meeting all these regulatory requirements because now you're self-managing. A word of caution, the grass is not always greener on the other side. Last episode, we spoke about superannuation. We spoke about fees and returns. And a lot of people have said, you know what, those fund managers, those superannuation funds, they're rip-offs. I'm getting out. I'm going to do it myself. And so here you are, considering a self-managed super fund, or maybe you've set one up. I have come across a lot of people who have set one up who I look at their financial situation when they come to me and I think, you should never have had a self-managed super fund. You don't have the risk profile for it. You don't have the money that's required in there. It's been sold to you. It's been sold to you and you didn't get proper advice as to whether that was in your best interest. Well, if that's a you, don't fret, because it's not the end of the world. That's something that we can still look at. But if you are thinking about a self-managed super fund, today's episode is for you because I want you to ponder why you're thinking about a self-managed super fund. Let's start at the beginning. What is it? Well, what it is, it's a structure. Again, superannuation is, as we said in the last episode, a structure. It's a tax structure. It's a trust. Every trust has members of that trust, right? Every trust has, so a typical family trust, for example, if you're in business, has beneficiaries. Superannuation is a trust, and therefore this trust has members. If you're part of a larger superannuation fund, there are thousands of members. In a self-managed super fund, typically, in most situations, there are only 2 members. It's usually husband and wife, partners, brother and sister maybe, but there's usually 2, sometimes 3 or 4. Okay, now what that means is that you still have your own member balances, which you bring into the self-managed super fund. A bank account is set up, the money is pooled together into that bank account, and then investments are made. So that's the structure of it, right? The structure of it. And so what we're going to do is we're going to go through, what do we got, 7 things we want to go through today in terms of a self-managed super fund so that you walk away today having some greater knowledge around a self-managed super fund, and you can then make a decision as to what's best for you. Now, even by the end of this episode, you may still not be able to make a decision, and that's fair enough, right? You may want to get advice. It's something that we do, something a lot of planners do. So if you need some guidance or advice, or you just want to bounce it off someone, maybe you just want to know, look, I've got 100,000. Is that really enough? And we'll have a chat about that. But just if you want to just bounce it off, then don't by all means make contact. Okay. One of the things you really need to be doing, because it's not just a matter of, well, let's go set it up and buy a property, or invest in some crypto, Bitcoin, all these things are amazing things. No, I keep away from them. I don't like to speculate. I'm 53. I speculate a lot in my 20s. I don't need to speculate anymore. But a lot of people do, right? A lot of people do, and it gives them the flexibility. So, but you need to look at things holistically. And one of the things you look at when it comes to a self-managed super fund is you've got to look at the fees. Fees are very important because a typical superannuation fund, the fees are charged typically on a percentage basis. So if you've got $100,000, for example, the fees they're getting charged in there could be upwards of sort of 0.8 to maybe 1%. So let's use 1% to 1.2 as an average. Let's use 1%. It'll make the figures easier. So if you've got $100,000, that's $1,000 in fees that you're paying per year. If you took that $100,000 and set up a self-managed super fund, well, for starters, it'll cost you anywhere between $3,000 to $7,000, depending if you're wanting to borrow and buy a property. So immediately, you've got 5% of that fund is gone in the setup. Now you've got to get that return back compared to being with a typical super fund. So that's a setup. And then you've got ongoing. And the ongoing fees are about $4,000 on average to maintain this superannuation fund, this self-managed superannuation fund year on year. Why? Because you've got accounting fees, needs to lodge a tax return, financial statements need to be prepared, the fund needs to get audited, it gets lodged, needs to have an investment strategy, needs to meet the sole purpose test. And so if that's costing you, say, $4,000, there's ASIC fees, that's the other thing, so the regulators have got their fees. And so if you need to pay for these fees, $4,000 on $100,000 is 4%. That's a lot to be paying when you could have your typical retail fund where you're only paying 1%. So $1,000 compared to $4,000. So that should have an impact in your decision making. So on that basis, it would make sense that it's better if the balance is a lot greater. So if we're using $400,000 as an example, where you're paying at a typical fund at 1%, $4,000 a year. A self-managed super fund, we said, is about $4,000. So at that sort of number, if you're looking at it purely from a fee perspective, now you're starting to say, okay, well, the fees are similar. So from a fee perspective, at least now I can consider a self-managed super fund. Whereas when it's lower, it's a low balance, the extra fees are eating into your return. The return then the investments of that fund needs to make up those extra fees. So compare the fees. Number two, why do people set it up? Well, you're thinking, well, I want some control, I want flexibility, and I want choice as to where I invest my money. Well, to some degree, you have all those three available to you in most superannuation funds these days. You can control where their money's invested. You have flexibility because you can make changes in that fund. And again, you've got some control over the investments, not total control, sure, there's this control aspect, but you've got to take all that into account when you're reviewing things, right? So a lot of people set up a self-managed super fund or feel that I want to take back control, I want to control my money, I don't want anyone else looking after my money. And a lot of people do set up a self-managed super fund specifically for property, right? Something that I've been seeing for years. In the last 34 years as an accountant, as an advisor, been working with self-managed super funds. A lot of people have been setting them up for property. However, in the last, I'd probably say 5 years, I've seen a lot more clients, a lot more people who have set them up, as I said before, really should never have had one, have purchased assets in there, usually a property that hasn't grown in value. That's a huge risk because you're banking all this money, your superannuation money, on one asset. It's great if it works, but if it doesn't work in the way that you've wanted it to or planned or thought that it would, it's having a severe impact on your long-term wealth creation, therefore your retirement. But a lot of people are using it for property. Now, if you've got enough money in super, like if you've got at least 400, 500, even 600, then it may be part of an overall strategy. You may be able to invest in a property and also be able to diversify in there and have a portfolio of shares as well. Remember, diversification, which is just investing in different things, good quality assets in different asset classes. Remember, that spreads your risk, it reduces your risk. Going back to that example, if it's just one property that doesn't go well, that is risky. We call that concentration risk because you're concentrating on one asset. It's just like if you used all that money to invest in crypto. You know, it could fly, but it could actually bomb as well. Or like you've seen, there's a lot of volatility with it. So you're concentrating on one asset. Not a good move if you're limited in the amount you've money and got super. If you got $1 million in super, could you put $50,000 in crypto? Yeah, of course. Why not? If the majority of it is in good, solid, long-term investments, as long as you're prepared for that 50,000 to either go to zero or just to go to 30 and then go to 40 and then fluctuate a fair bit, then, you know, maybe that's an option. Again, this is not personal advice because I don't know your personal circumstances. If you do want me to know your personal circumstances, then come see me. Click on the link or whatever is there below or in the show notes. Okay. So property is a big thing, obviously, within superannuation funds, with our self-managed super funds. And we do see a lot of it, you know, at the moment. There are a lot of property marketing groups out there, isn't there? You know, I know some good ones. I know some not so good ones. I've seen both. I see clients who have worked with both. I've seen property values in self-managed super fund go up. I've seen ones that were purchased 8 years ago and they've gone down. They've done nothing but go down. And the clients are now saying, what do I do? Because then you're at a time where you've got to decide, do I cut my losses, sell, take whatever's left and invest that for the next whatever time frame you have, 10 or 15 years, or do I believe in this and say, well, it's going to go up at some point? Yes, that is the $1 million question. But that's what we do when it comes to a financial plan and doing the analysis and saying, okay, what are your options here? Which option will give you the better long-term return, and ultimately which one puts you, looks after your best interest and puts you in the better position. When it comes to buying property, the thing is that I mentioned before the cost of setting up a self-managed super fund is going to range between $3,000 and $7,000. The reason for that is if you're just setting up a self-managed super fund and you're not borrowing to purchase a property, then you're going to be around that $3,000 mark, okay? Because you need a structure, you need the superannuation fund to be set up. Then there's trustees. Every superannuation fund, so every trust, every super fund has a trustee, and you need to make a decision as to whether the trustee is you yourselves as individuals, or do you set up what's called a corporate trustee, which is just a company. And so that's where the costs are. Now, the $7,000, closer to $7,000, is if now you're borrowing to purchase a property. So you're taking out a loan and you're purchasing a property. Now, the reason why it's more expensive is there's an extra structure that needs to be set up. In 2007, when the Australian government allowed borrowing within self-managed super funds, that's when it really started to, people thought, okay, great, I can now borrow in my self-managed super fund. I can now purchase property. I can now borrow for shares, borrow whatever the case. But when it came to the property specifically, the regulators, the government mandated the structure. And they said, you know what you need to have is what's called a limited recourse borrowing arrangement. What that is the property, so the asset that's being acquired, needs to be set up in a separate structure to the superannuation fund. And you can hear you saying, well, that's getting a bit complicated. Well, it is complicated, and that's why self-managed super funds are not something that should be taken lightly. Now, we give advice to clients. We set them up. We do all the compliance and make sure that, it gets audited and all that sort of stuff is you're protected and you meet your compliance obligations. But it's still, ultimately, you have that responsibility. So you need to do your due diligence and look into it. So getting back to that structure, when you're purchasing a property and you're borrowing, that property needs to be owned in a separate trust. It's called custodian trust or bare trust. And again, that trust needs to have another trustee, and usually it's a corporate trustee. The reason for that is when a bank lends money to a self-managed super fund for a property, the borrowing is what's called limited recourse. So it's the term limited recourse arrangement. Because the bank can only access, if there's a default, the bank takes security over the property, just like it normally would, but the bank only has access to that particular asset. If the super fund has shares or other assets, and there's a default on the payment, and the bank sells that property, and if there's a shortfall, the bank cannot go after other assets of the fund. And the regulators mandated that because they didn't want people going crazy in their self-managed super fund now that they're allowed to borrow and put all their super fund assets at risk. Because one of the key tenets of a superannuation fund, and certainly of a self-managed super fund, is you've got to meet the sole purpose test. And the sole purpose of a superannuation fund is to provide for your retirement. That is the sole purpose. So that's the structure, and so it's costly to set up, right? And therefore costly to maintain. As we said, there's concentration risk because if you're doing one property, it's all concentrated on this one property, and that one property needs to work. And if it doesn't work, it has an impact on your wealth. Cash flow you've got to look at because cash flow, you've got to look at the rent that's coming in, your employer contributions going in. You may need to top it up. Okay, we had a lot of clients that come through that they're short of cash flow in the fund because, interest rates have gone up now and they're having to top it up and they don't have the funds really because they've got a loan on their home. And that needs to be topped up. So cash flow is important. As we said, you may have some insurance in there as well. So you've got to do those numbers, do the cash flow. You may need to make some extra contributions. And so your fund needs what we call liquidity. It needs to be able to have some cash to pay its expenses. You've got those annual expenses. You've got the insurance it needs to pay, the expenses of the property, but also needs to pay what's called a death benefit if one of the members passes away. Now, if, for example, all the money is in a property, and let's give a simple example, right? There's $200,000 each member, so there's $400,000. That $400,000 is being used to buy a property. What would you get with $400,000? Yeah, not much, but just for this purpose, let's use $400,000. So what happens? All that money is in that $400,000, but one of those members passes away. Their member balance, which was that $200,000, that needs to come out of super. It can't stay in super. Right? So that member balance of $200,000 needs to come out and be paid to whoever they've nominated. Now, the other member, when they get the money, they can put it back into super, but it first needs to come out. And if the liquidity, if the funds aren't there, if that $200,000 isn't there, and if there's no insurance to pay for that, that's why you really need insurance if there's borrowing in the super fund. If they don't have that, then the property would need to be sold. And you may then have to sell the property at the worst possible time. You may not want to sell the property because that's there for your retirement. So these things can put it all at risk. All right, what else are we looking at? What are the setup costs? We've gone through that. Responsibilities. So this is the thing, right? You've got responsibilities when it comes to a self-managed super fund. You've got to manage the fund. You've got to do the admin, the requirements of a superannuation trustee, because remember, you're becoming the trustee. Or if it's a company, you're the directors of the corporate trustee. You've got to make sure that the funds that are, the contributions that are being made, that the member making the contributions is eligible for that amount, and it's got to be allocated, and it's got to be invested. There's got to be proper reporting. The fund needs to get audited every year. That's got to get ticked off. That report goes off to the tax office. If there's any issues with that, you'll get a phone call. And you need to ensure that you meet the sole purpose test, as we spoke about before, which is the sole purpose is for your retirement. And so this is key because the regulators don't want you taking control of your money, and then what was happening many years ago where people were then buying cars and paintings. Back then, you were even allowed to use your superannuation money to buy your own house, right? That was pretty cool, but although all that's been knocked on the head, locked away, you cannot do that anymore. So the sole purpose is there for your retirement, not to pay off your home. But that was good while it lasted. The other thing is there needs to be an investment strategy, a documented investment strategy, which needs to be documented, listed, and said, okay, this is the investment strategy of the fund. This is how much we're going to be investing in property, how much in shares. And if it falls within that, then you could be breaching your obligations as a trustee, and you've got to be careful of that. Last thing to finish off, seventh item. I think we're up to the seventh. Last thing to finish off is watch out for scammers. Because this is the one, as I said, it's the people out there who've got an appetite for self-managed super funds, and there are scammers out there who can say, look, we can set up a self-managed super fund for you and you can get access to your superannuation money. Because a lot of people see that money there and they think, I'd love to get access to it because I can pay off my home loan, I can go on holiday, I can go whatever the case. Not allowed. You've got to reach we said in the last episode, you've got to reach your preservation age. That's the only time you can access it. So accessing it early is a no-no for your personal use. And so beware of these scammers. There's a lot in the last 5 years who've gone to jail, and they actually, some of them weren't even licensed at planners, right? So be careful. The other thing, just a final warning, be careful with some property marketing groups, right? As I said, there's good ones and there's bad ones, just like any other industry, but be careful of them, because if you're being sold on a product, because the self-managed super fund is a product, before you know what the strategy should be for you, that's like going to the doctor and saying, I've got a sore back, and the doctor says, starts prescribing a particular medication. You say, hang on, you haven't even asked me, is it sharp pain? Is it dull pain? Does the pain shoot down my leg? Is it only at night? The diagnosis needs to be done. Once that diagnosis and the tests get done, the product is the easy part, the prescription's the easy part. So this is similar. So when you're looking at your financial plan, we can have a look and say, is a self-managed super fund in your best interest, right? Because if it's not, going and setting up the product and then just buying an investment property can be a lethal mistake. It could be disastrous for your finances. It's worked for a lot of people, but remember, what works for one person is not necessarily a good thing for another person. So that's been the discussion on self-managed super fund. I hope that's been value to you. This is our industry, been doing this for 34 years. So if you're wanting some feedback, guidance, just a second opinion, by all means, get in touch. But hopefully that's given you an insight into self-managed super funds and the things you need to be thinking of and the things you need to be aware of. So thanks for joining, and we'll see you next time. And a final thought, question, something we want to bust, or something that we get with a lot of questions on or comments. When it comes to superannuation, we've been talking about self-managed super funds today, which is superannuation fund. When it comes to superannuation, a lot of people over the years have been saying, I don't care about super. I'm investing separately. I'm not relying on my super. I don't care about it. I don't know what it's doing. I don't know where it's invested. Don't do that. Don't do that. It's your money, Ralph. Wasn't there a commercial or something years ago? It's your money, Ralph. Might have been the CBA Bank years ago. I'm showing my age. It's your money, Ralph. So it's your money. This is your money. Remember, your employer is putting 11% of your gross income every year. On $100,000, it's $11,000 you're getting every year. So look after it. Make sure you like it. No, sorry, you don't have to like it. But make sure you get advice on it. Look at it, where it's invested. Because when you get towards retirement, you're going to wish you had a lot more in there. Trust me. So look at your super. If that's the message I want to give you, look at your super. And here you go, that's boring. We'll make it fun. Come see me. We'll make it fun. All right, that's another episode of the Plan to Prosper podcast. Thanks for joining. We hope it's been valuable to you. We want to give you plenty of valuable. And remember, when you plan to prosper, you have peace of mind.